Hi guys, in this video we will be continuing with the budget revision template focused on the tab titled Cash Flows, which I have open behind me. This is a simple worksheet. We have a cash flow statement that pulls net income from the prior tab and then some balance sheet line items projected underneath it. So we're not working with a three-statement model, which is what I would normally recommend, because here we're just trying to create a framework to make very difficult decisions in an uncertain time. So with that preface, I think we can go ahead and get started, and we'll just dive right in. And before we get started, if any of this is foreign to you, I would recommend reviewing the three-statement model. If you need a quick update on this topic, you can find links to 2 videos that will walk you through the process in its entirety, pasted below. To get started, let's expand all grouped rows so that we can get a better look at this worksheet. And until we take a look at the balance sheet items below, I'm going to keep the historical period grouped with the exception of the first and last month. Now the top portion of this tab is effectively a simple cash flow statement. We are starting with net income, pulling from the tab titled Budget Revision, and then adding back non-cash items. Here we only have depreciation and amortization, but you can add anything your business might require. Then below that, we're making adjustments for working capital to arrive at cash flow from operations. I've included 3 accounts frequently found on most balance sheets, but feel free to incorporate additional detail. Next, we have capital expenditures, which has been left blank for your purposes, which gets us to cash flow before debt. And once you subtract mandatory debt repayment, you have free cash flow for the period. And you can input your starting cash balance here in cell U27. And these 2 values summed will give you your ending cash balance. Now, what you may have noticed as we walk through this is that when a business shrinks, it can create cash, especially if there was a lot of working capital tied up in the business. And on that subject, I want to explore projecting inventory. When you have a severe correction, the common approach of using days of inventory outstanding does not work because the corresponding reduction in inventory assumes that the inventory is sold, which is not likely to be accurate. So what we've done here instead is create a new schedule that reduces inventory by the sum of all line items in COGS, because that is what is actually sold in the period. You can press Ctrl, open bracket, and expand this selection for COGS to see that the cells selected are summed. Press F5, enter. And then what we've done below that is add back the amount required to maintain the historically accurate relationship between inventory and COGS. And if this sum is negative, it returns 0 because you effectively have too much inventory. In other words, the calculation maintains inventory balances to reflect only what you can actually sell and limits purchases when your inventory balance is in excess of this historical relationship. Now in this template, we've provided the option of either using the traditional days of inventory outstanding approach or this new approach in line 53. And what you will see if we switch to the traditional approach is that you get a much higher cash value in the first period that revenue drops because we have overstated what was sold. For this reason, I'm leaving the input at 2 so that it pulls from the approach we just went over. And with that explanation, I want to get back to the fact that your business has shrunk. To quickly illustrate this, let's take a look at working capital accounts and cash over the projected period. If we subtract assets from liabilities, you'll quickly see how this value has declined over the projected period. To further illustrate the point, let's assume that you want to get back to your original inventory level. If you were to take all of your cash and sum it with your ending inventory balance in the final period, it would still fall short of the inventory balance at the beginning of the period. And this doesn't include equipment and the related capital expenditures. If you chose to forego capital expenditures during this period, then that cash balance cannot be used for this purpose anyway. In fact, the only reason we have a positive cash balance is because the business is nowhere near its prior revenue levels. To illustrate, let's assume demand came back all at once. Keep these positive cash flow figures in mind as we run through this exercise. Back on the Budget Revision tab, we'll expand the group selection for revenue, and then push revenue back to 100% of budget in November and December. On the Cash Flow tab, you'll see that just getting back to where you were at the beginning of the period creates a significant funding gap, which means that you have to be very careful with your cash balance because it will take all available liquidity and then some to recover after a severe drop. Fortunately, working capital still leaves a few levers to pull. Assume, for example, that you could contact your vendors and let them know that until your business recovers, you need to renegotiate payment terms. So while historically your days payable outstanding balance has been 31.5 days, you might want to explore how an adjustment can allow you to overcome a funding gap. So to do that, we'll code these as inputs really quickly. And let's start with small, approximately 5-day increments. And you'll note that at 45 days, this allows you to survive the projected period while maintaining a positive cash balance. So once you have this information, it would then be your responsibility to call all of your vendors and attempt to renegotiate terms until you can work towards this average. All right, team, that's it for now. I hope this has been helpful.